Welcome to the Limitless Retirement Podcast. My name is Danny Gudorf, the owner of Gudorf Financial Group. Whether retirement is on your horizon or you've already made the leap, this podcast tackles your most important questions in retirement. Every episode, I'm here to share valuable tips and strategies to help you succeed in retirement. So let's go ahead and get started with today's show. When the market drops, everyone starts asking the same question. Should I buy the dip? It's a question that becomes even more critical when you're in or approaching retirement. Today, I'm going to reveal the surprising math behind market downturns and show you exactly how to approach buying the dip, whether you're still building wealth or already drawing from your portfolio. The truth is, market declines happen far more often than most people realize. On average, the stock market experiences a 10% correction about once every year, a 20% bear market every 5 years, and a 30% or greater drawdown about once a decade. So if you've been checking your portfolio lately and feeling that pit in your stomach, remember, this is completely normal. But here's what separates successful retirees from those who struggle. Understanding that volatility isn't a bug in the market, it's a feature. And if you approach it with the right strategy, market dips can actually become powerful opportunities to strengthen your retirement plan. Before we dive deeper, I want to share something that completely changed how I view market downturns. When prices fall, expected returns actually rise. This isn't just theory, it's backed by historical data. After the S&P 500 has dropped 10%, the average one-year return from that point forward is 11.7%. After a 20% drop, the average one-year return jumps to around 22%. That's the opportunity hidden within the fear. But here's the critical insight most people miss. You don't need perfect timing to benefit from a downturn. Market recoveries often begin when things still feel terrible, when headlines are scary, the economy looks weak, and many investors are sitting on the sidelines. That's exactly when markets begin to turn. Let me share a powerful equation that puts this into perspective. If the market drops 33%, it needs to rise about 50% to get back to its previous high. So if you think recovery will take 1 year, your expected return is 50%. If you think it will take 2 years, that's still 22% annually. 3 years, 14% annually. Even a 5-year recovery, hardly a blazing comeback, would offer returns of 8% annually, right in line with the stock market's long-term average. This equation shifts your thinking from how bad does this feel right now to how long am I willing to wait for a strong return. When markets fall, the math starts working in your favor. Now, let's get practical. How should you approach buying the dip if you're still in the accumulation phase, still working and building wealth? First, consider investing idle cash that you don't need in the short term. This doesn't mean raiding your emergency fund, but if you have extra cash sitting in checking or savings accounts earning minimal interest, a market dip could be an excellent time to put some of it to work. Second, think about accelerating your contributions. If you're regularly putting money into a 1K or IRA, consider front-loading those contributions if you can afford to. Instead of spreading them evenly across the year, increase them temporarily to take advantage of lower prices. Third, you might consider using part of your emergency fund, but only if it's robust, think 6+ months, and you feel comfortable dialing it down temporarily. This comes with a big asterisk. Only do this if your job is secure and you have a high tolerance for risk. Fourth, redirect any windfalls. Bonuses, tax refunds, or unexpected income can be directed straight into investments during a downturn rather than being spent or sitting idle. Finally, if you've been considering a Roth conversion, a market decline can make this move more appealing. You'll pay taxes on a lower balance, and any future rebound happens inside the Roth, completely tax-free. The common thread across all these strategies is simple. Don't invest money you'll need soon, and make sure you're staying consistent with your overall financial plan. But what if you're already in retirement or the decumulation phase? Your approach to buying the dip will look different, but you still have powerful options. First, use your cash reserves to avoid selling. If you follow a bucket strategy, and I recommend retirees keep 1 to 2 years of spending needs in cash, you've already built a buffer. That cash gives you the freedom to avoid selling investments at depressed prices, which helps your portfolio recover faster. Second, if you've built up more cash than necessary, consider putting a portion to work. Rebalancing your portfolio during a downturn by moving money into equities can help maintain your target allocation and potentially benefit from a rebound. Third, you might consider adjusting your allocation if you can tolerate more risk and don't need to withdraw for a while. For example, moving from a 60-40 to a 70-30 or even 80-20 allocation. But this isn't a casual decision. It should be grounded in your long-term plan. Fourth, use rebalancing as a strategy. If your portfolio has drifted significantly, say stocks are down and bonds are up, rebalancing gives you a natural way to buy the dip. It's disciplined, unemotional, and often very effective. In retirement, the key is to buy the dip only if it enhances your ability to meet long-term goals. And remember, you already have one of the most powerful tools, a cash cushion, to keep you from selling in a downturn. Now, let's talk about the mistakes to avoid when buying the dip, because these can derail even the best intentions. The biggest mistake is trying to time the bottom. Nobody rings a bell at the market bottom. If you wait for the perfect moment, you'll likely miss it. Focus on process, not precision. Another common mistake is overcommitting. Don't put so much cash into the market that you're left financially exposed. Always keep your safety net intact. Equally dangerous is reacting emotionally. Buying the dip should be a strategic decision, not driven by fear or missing out. If emotions are driving your choices, take a step back. Many investors also make the mistake of ignoring their asset allocation. A good deal on stocks isn't helpful if it leaves your portfolio out of balance or outside your risk tolerance. Finally, the most common mistake is simply not having a plan. If you don't have a framework for when and how to invest during downturns, you're just guessing. Pre-committing to a process like rebalancing thresholds or scheduled investments makes execution easier and more effective. So, should you buy the dip? If you have the right plan, the right resources, and the right mindset, buying the dip can absolutely work in your favor. But don't confuse action with progress. The key isn't doing something flashy, it's doing something smart. For those still building wealth, think about ways to invest more consistently and intentionally during downturns. For those in retirement, remember that your cash cushion and rebalancing strategy already put you in a strong position to weather volatility. Above all else, stay disciplined, stay diversified, and stay invested. Market dips are inevitable, but they also create some of the best opportunities for long-term investors who approach them strategically. Thank you for listening to another episode of the Limitless Retirement Podcast. If you want to see how Gudorf Financial Group can help you get the most out of your money, go to gudorffinancial.com/get started. This is where you can schedule a 20-minute call to see how our firm can help prepare a free retirement assessment. Please remember, nothing we discuss on this podcast is intended to serve as advice. You should always consult a financial, legal, or tax professional that is familiar with your unique circumstances before making any financial decisions.